Hi, I'm Patu from freefincal, and let's ask if this is a good time to buy mid cap and small cap mutual funds. Well, technically, this, in my opinion, this is a wrong question to ask, and I think there's no need to ask this question if you had a proper investment strategy. But let's first look at the mid cap market trend. I have a tool called the Nifty Valuation Analyzer. This is available for purchase at freefincal via this link. So in this link, you can evaluate the market valuation, whether it's cheap or expensive, using multiple methods, using simple moving averages, exponential moving averages, moving average convergence divergence, the RSI indicator, PE, PB, EPS growth rate, multiple ways. So what you see here is the Nifty Mid Cap 150, and you have the 6-month moving average, nearly 6-month moving average, represented by the red line. The 1-year moving average represented by the black line. The price index is in blue. You can see that the current price index is well below both the 6-month and 1-year moving averages. So that's a good indicator for buying. But don't get excited as yet. Not done. Then you can have a look at the Bollinger Bands. The Bollinger Bands are excuse me. You can look at market volatility as well as trend. Excuse me. Using the Bollinger Bands, you can see that the upper and lower volatility bands are shown here. The gap between the upper and lower volatility bands are well separated, and the current price index price is hitting or even well below, a little bit below the lower volatility band. This means that the volatility in the market is expected to continue for a little more time, but in terms of valuation, it's a good time to buy. I've also had a look at the PE of the Nifty Mid Cap. There's not much data. You can see the 10-year moving average right here. This is the first standard deviation, one standard deviation above, two standard deviations above. You can see that the Nifty Mid Cap had gone well above that and has been on its way down. It had moved up a little bit and then it came down. It's very close to the average, 10-year average. So again, from that point of view, in terms of price to earnings, it's not a bad time to buy. It's not, you can't hope to catch the bottom, so it's okay in terms of buying on um, uh, in terms of entering the market. But what do I mean by entering and what do I mean by buying? I am not talking about fresh investments. Please remember, buying on dips is an immature idea. You have to, if you are interested in entering at market lows, you must enter from your other asset classes. For example, if you have equity and let's say you have 50% large cap in a large cap fund, 25% in a mid cap fund, 25% in a small cap fund, then if you think that the mid cap and small cap market valuations are attractive, you must book some profit from large cap and move it to mid and small cap, or however way you want to play it. That is what I mean by it's a good time to buy and a good time to enter. I am not talking about fresh investments. The problem is that people are always worried about their fresh investments because what is happening is when they start investing, the monthly investment divided by the total investment value, that is your current monthly investment divided by the total investment value, is a big number. It will be like 5%, 3%, 4% or so. But plus, please have a long-term view and imagine a time where the monthly investment divided by the total invested value is 1%, or it is less than 1%, it's 0.1%, something like that. Then the total invested value will be so large in amount that you will be worried about that risk and not worried about when you will be investing the next installment. So you should have the correct viewpoint about that. To illustrate this, I have shown the results for 3 SIPs. So what you see here is a large cap investment, 1,000 rupees in a large cap fund, 500 rupees in a mid cap fund, 500 rupees in a small cap fund. So the asset allocation is 50%, 25%, 20%. This is only the equity part. The SIPs were started on 1st July 2017 or early July 2017, and the current value is shown here. The SIPs are very poor. It's 2.54 for a large cap fund, 3.45 for the mid cap fund. Small cap is actually negative, so the XYRR is basically zero. So the starting asset allocation is when the time you started the investment, the starting asset allocation is 50%, 25%, 25%, and that's your target asset allocation. After 2 years, the current asset allocation is 52% in large cap, 26% in mid cap, 21% in small cap. So you have to rebalance it back to 50% large cap, 25% mid cap, 25% small cap. When you do that, you will have to, so this is the current value and this will be the rebalanced value. So you have to do this rebalancing, which means that you have to take 4% out from your large cap investment, 5% out from your mid cap investment, and add it to your small cap investment. And that addition to the small cap investment would represent 16%, an addition of 16% compared to the current value of the small cap investment. So don't look at market trends, have a target asset allocation and keep looking at your asset allocation and rebalance it. If you think some market has gone, there's a correction, so-called correction, then you look at your asset allocation, and if you think it's a good time to rebalance, do the rebalancing. Automatically you will be investing additional amount in small caps and mid caps. Of course, in this case more in small caps because of the situation, but if you have a large and mid caps portfolio, then you may have to invest more in mid caps. So that is the kind of, the point I'm trying to make with this video is all the answers for managing your portfolio lies within you, within your requirements. As long as you have a proper investment plan, everything else will be automatically answered. You don't need to ask, shall I do this, shall I do that, should I do buy now, should I sell now? All the answers are within you. Why are you looking at market trends when you can actually look at it from your portfolio? So please look at your portfolio and do the rebalancing, then automatically you will be invested more in asset classes that are down. That's the point, right? You'll be booking profit from asset classes which are moved up to moving to money to asset classes which are down. Of course, you should understand the risks associated with mid caps and small caps, but that's life. And you should do this only for very long-term goals. If you don't want to do all this, stick to an aggressive hybrid fund or a multi-cap fund. Let the fund manager do it. You leave it alone and don't waste your time. Just don't add another fund to your portfolio and clutter it up. So that's what I wanted to say in this video. If you have any questions, ideas, or comments about this, please leave them below. Thank you, as always, for watching. Bye-bye.